Welcome to today's Explainer. We are unpacking something absolutely fascinating today, a concept known as the intelligence paradox. Society feeds us a pretty straightforward story, right? We're told that if you're smart, you get good grades, you earn a prestigious degree, and boom, financial success just naturally follows. But real life? Well, real life often tells a completely different story. Today, we're exploring exactly why high academic intellect so frequently fails to translate into a high bank balance. We're going to dig into the behavioral economics, the psychology, and the absolute fundamental differences between academic smarts and true financial intelligence. Okay, let's dive into this. What if your intellect is actually being pointed in the completely wrong direction? I mean, we see it all the time. Some of the smartest people in the world, top scholars, brilliant academics, they're struggling financially. Meanwhile, people who were maybe just, average students end up building extraordinary wealth. So, why does this happen? It's not about who is inherently better. It's really about the systems they're playing in and the rules they're following. If you've ever felt like you're doing everything right, but somehow still aren't getting ahead financially, this explainer is going to show you exactly why. Section 1. The Systemic Trap, Academic Success versus Wealth Creation. Now, our traditional education systems are incredible at a lot of things, but they honestly tend to wire intelligent people for the wrong financial game. There is this stark contrast between these two environments. Think about academia. Success there is heavily focused on getting the one correct answer and avoiding failure at all costs. You memorize the material, you take the test, you get the A. But wealth creation, it couldn't care less about a standardized test. Business and the real-world economy reward people who solve real problems and take calculated risks. Schools are essentially rewarding rule following to make you highly employable. Wealth, on the other hand, requires you to step way outside those lines, look failure right in the eye, and create value where literally none existed before. It's kind of ironic, but it's true. The A students very often end up working for the C students who took that entrepreneurial leap. And because intelligent people are so incredibly good at navigating the academic system, they effortlessly fall into what we call the employee trap. You work hard, you earn your degree, you get a great promotion, and yeah, you receive a high W-2 salary. But there's a huge catch. Your income is strictly tied to a time for money exchange. It doesn't matter how brilliant you are, there are only 24 hours in a day, which puts a hard ceiling on your income growth. Plus, those high W-2 salaries usually face the harshest tax implications. And the biggest piece missing from the whole shebang? A lack of ownership. You are out there building someone else's equity, not your own. Section 2. The psychological barrier. Why smart people delay action. So, moving beyond just the systemic issues, we really need to look internally at a major hurdle: analysis paralysis. Intelligent people are exceptionally good at gathering data, but that strength actually becomes a trap. So the crucial point is that, driven by perfectionism, a fear of judgment, and this intense need for certainty, smart people will research a real estate investment or a business idea for literally years. They are constantly waiting for the perfect time, or for just a little more knowledge until they feel 100% ready. But in the world of wealth, taking consistent action almost always beats endless preparation. While the intellectual is sitting there waiting for absolute certainty, the action taker is already out in the market, getting real-world feedback and adjusting on the fly. And oh man, when that smart person finally does land that high-paying job, they almost immediately fall into the lifestyle inflation trap. The salary goes up, but guess what? The expenses rise just as fast, if not faster. When we break down the numbers, we often see a staggering 60% going straight to luxury and status spending. The bigger house in the right zip code, the designer clothes. Then another 25% gets eaten up by debt and luxury car payments, and 10% vanishes into recurring subscriptions. That leaves a microscopic 5% sliver for actual asset accumulation. It's wild. This constant status seeking and the desire to just look successful ends up devouring the very capital needed to actually be successful. Section 3. The Wealth Equation: Intelligence versus Financial Intelligence. To fix this, we have to completely reframe how we view income. Working hard basically means generating income from labor. You're paid for your effort. If you stop working, well, the money stops flowing. Creating value, on the flip side, means generating income from assets, where you are paid for ownership. This is exactly how millionaires think differently. They don't just want to be workers getting paid for effort, they want to be investors paid for ownership, or creators paid for attention. Wealth scales through leverage and value creation, not just by clocking more hours at a desk. And this brilliantly illustrates the specific, high-value skills you need to actually bridge that gap. skills they definitely do not teach you in a university lecture hall. You need marketing and sales, because that fundamentally increases your opportunities and helps you communicate your value to the world. You absolutely need financial literacy to understand cash flow, taxes, and how to effectively allocate your capital. And you need robust problem-solving skills, because when you solve complex problems, you create immense value for others, and in a free market, you are compensated for the scale of the problems you solve. When you apply those specific skills over a long period, you tap into this truly magical concept, compound growth. Now, most people hear compounding and just think about money sitting in an index fund, but true financial intelligence recognizes that literally everything compounds. Your knowledge compounds, your skills, your professional relationships, your business systems, and yes, even your healthy habits grow exponentially over time. It's like a giant snowball rolling down a hill. The small, disciplined decisions you make today might seem totally insignificant right now, but over a decade, they build unstoppable momentum. I want you to remember this fundamental truth. Wealth is rarely built by intelligence alone. It grows through good decisions, disciplined habits, valuable skills, ownership, and patience over time. Being academically smart gives you a really great processing engine, no doubt. But if you don't combine that engine with resilience, delayed gratification, and ownership, well, your engine is just sitting there idling. Section 4. The Execution Plan. Escaping the Cycle. Okay, we've covered the traps, we've talked about the mindset shifts, now let's get super practical. Here are the 4 foundational steps to move from being a salary-dependent employee to an actual owner. Step 1, improve your financial literacy. You just have to learn the language of money and deeply understand the difference between an asset and a liability. Step 2, develop those high-value skills, the sales, the marketing, and the leadership abilities we just talked about. Step 3, spend less than you earn. You absolutely must conquer lifestyle inflation and carve out some capital for yourself. And finally, step 4, own productive assets. Use that carved out capital to buy stocks, invest in real estate, or build a business. That is the exact mechanism for transitioning from working for your money to finally having your money work for you. Let's move to our roadmap and see how this builds over a realistic time frame. Spoiler alert, this is not a get-rich-quick scheme. This is an evidence-based 10-year wealth roadmap. Year 1 is all about aggressive financial education. By year 3, you're leveraging those new high-income skills for major career growth, or maybe you're launching a side business. By year 6, your primary focus shifts to heavy asset accumulation, funneling all that extra cash flow straight into investments. And by year 10, you're shifting into long-term wealth management and really scaling up your systems. Now, of course, financial outcomes depend entirely on your individual circumstances, but having a solid decade-long horizon prevents you from making those panicked, short-term mistakes. If you're looking to dive deeper and really continue building out these mental models, I highly, highly recommend picking up these books. The Psychology of Money will fundamentally change how you view risk and greed. Atomic Habits is brilliant. It'll show you exactly how to build the systems for compounding growth. The Almanac of Naval Ravikant is basically a masterclass in leveraging specific knowledge and creating true wealth. And Rich Dad Poor Dad remains the absolute classic text for understanding the basic difference between buying an asset and buying a liability. Section 5, the takeaway, beyond intelligence. As we wrap up this explainer, let's focus on the ultimate takeaway here. Being smart is a wonderful gift, but it is literally just the starting line. It's not the finish line. The intelligence paradox only traps you if you allow it to. So you have to ask yourself right now, will you remain comfortably trapped, just trading your precious time for a paycheck? Or will you actually take action? Take those calculated risks and build the systems that make your money work for you. The choice is entirely yours. Thank you so much for joining me in this explainer. Keep learning, start building, and I will see you next time.